What's up, YouTube? Welcome to
The Financial Twins. I'm Mark.
And I'm James.
And today we're going to be talking about compound interest and how you can use it to build your wealth.
If you were given the option of $1 million right now or a penny that doubled every day for a month, which would you choose?
The penny would be worth 1 cent a day, then 2 the next day, then 4, then 8. That doesn't sound that impressive. The amazing thing is what it can turn into in just a short amount of time. Let's see what happens after 30 days.
With 1 penny that doubles every day, after 10 days, it's worth $5. After 20 days, it's worth $5,000. But by day 30, it would now be worth $5.3 million. Fun fact is if you keep going up to the 45th day, you'd have the same amount of money as Jeff Bezos.
The reason this happens is compound growth. The new total is growing by the new value of what it was and the new growth each day. Every day, you are effectively doubling the asset's worth. In investment terms, you'd be getting 100% return on investment, also known as ROI, per day. 1 turns into 2, 2 turns into 4. Although it is an extreme example, it can show the power of compound interest. So 1 turns into 2, 2 turns into 4. It isn't a fixed growth that grows 1 to 2 to 3 to 4.
Compound interest is reinvesting your money, and that reinvestment generates additional interest in your asset. An example would be investing $100 at 10% a year, and by the end of the year, it's worth $110. If you leave it in there for 1 more year, that $110 turns into $121, which would turn into $133, et cetera, et cetera. After 10 years, it would be worth $260. After 30 years, it would be worth a whopping $17.45.
Albert Einstein is usually credited by saying compound interest is the 8th wonder of the world, as well as saying he who understands it earns it. He who doesn't pays for it. You can see with the examples that I've shared that compound interest is a powerful tool. It takes time to build momentum, but it can turn small investments into large ones, given a good return and enough time. Let's say there's a young investor who is 18 years old. Let's call him Ben. Ben puts $100 a month away for retirement. He starts off with nothing, and he saves for 47 years. That's from the age 18 to age 65, most common age for retirement. He expects 10% rate of return. How much will he have by the time he retires? $1.1 million. Without going into the specific investments or even what those investments can give for ROIs yearly, let's go through some hypotheticals. Let's tweak Ben's numbers and see how it changes. If you upped the ROI from 10% to 12% yearly, that 1.1 million turns into 2.1 million. If we up it again to 14%, the new amount's 4.3 million. If we dial it crazy high to 20%, it's a whopping $39 million. And this is still with only $100 a month. That's a lot of money for Ben. That rate of return is also why you see why corporate business stress over every penny, because the difference of 15% ROI and 15.5% could be millions of dollars for them over the years. Now, some of you might think that to expect higher than 10 or 12% growth every year would be ridiculous, but it really comes down to what investments you are putting your money into. As far as what investment get what type of returns, I will be making a video on that later, but let's at least make a baseline of what to expect.
Which brings us to the S&P 500, one of the most common index funds on the stock market. All this fund is a group of stocks that track the performance of the 500 largest companies listed on the stock exchange in the United States. You'll typically see companies like Microsoft, Apple, Amazon, Visa on this fund. Think of this fund as a big pie, and each slice of the pie has a piece of each company. By buying this pie, you get pieces of a bunch of company stocks. This is also known as an index fund. I'm not saying you need to invest in this fund, but it stands as a good gauge of what to expect for a standard investment. This is typically the fund that companies have in their 401ks.
The S&P 500's average return varies year by year, but in the last 30 years, on average, it has appreciated its value by 10% each year. This would follow the earlier example with Ben, who was 18 years old and invested $100 a month until he was 65 years old and then retired with over $1 million. Now that you have a basic understanding of how compound interest works, how does it help you retire or become financially independent? We will go over some numbers. I highly encourage you getting through this next part, even if math isn't your favorite subject. It's pretty basic.
Let's stick with our Ben example. He's now 65 years old, and let's round his retirement to an even $1 million. In his retirement, for basic math, if it keeps growing by 10% in 1 year, it will grow an additional $100,000 for a new total of $1.1 million. He just made $100,000 from doing nothing.
In a perfect world, he would take it all out, live off that 100K, bringing in his investment from 1.1 million back down to 1 million. Again, in a perfect world, every year for the rest of his life, he could live off that 100K that 1 million generates every year. Even after he is old and passes away, he could then give that money to his kids, who would then be able to live off that 100K for all generations after him, creating generational wealth, which is the dream.
The problem with this is every year will not be a consistent 10% return. You will have really good years and also bad years that could be negative. But overall, the goal is a steady climb up. Another issue is inflation, typically anywhere between 2 to 3% every year. That means that every year your money would have 2 to 3% less buying power. Think of how cars and phones keep getting more expensive year over year. That will just continue. Our grandparents would make $10,000 a year, and that was a very livable wage. Nowadays, it's much higher than that due to inflation, as well as other issues we can't get into yet.
To be conservative, we usually calculate 3% inflation. This means that although Ben, in our previous example, is getting 10% rate of return, due to inflation at 3%, it's more like he's getting 7% growth. This means by the age of 65, even though his account is $1 million, $1 million by that time he's 65 would be today's buying power of only 400,000.
So recalculating those numbers, he's effectively getting only $40,000 a year. Still pretty decent for not doing anything all year, but might not be enough to retire given the average income per household in America is around $50,000.
The other problem with inflation is if you always take the whole growth, the 10% growth of the 400,000, then you will only have the 40,000 growth for all that time. And inflation will eat away at it every year. 40,000 might sound good right now, but due to inflation, in about 20 to 25 years from now, be worth half that amount.
This is the reason people recommend only pulling out a portion of the growth of the investment. Most people agree that 4% is a good number to pull out of the total investment. If it grows by 10%, it really only grew 7% due to inflation, which is roughly 3%. If you're talking about 4%, that leaves 2% in your growth to be put back into the investment to keep growing and beat inflation.
We know this is a lot of numbers, but to put it simply, that 1 million can keep growing, outpacing inflation, and could then be used for generational wealth if you only take out 3 or 4% a year, assuming it keeps growing at about 10%.
That means with $1 million, the growth is $100,000 in 1 year. You would only take out 40% of that growth, which would be $40,000, leaving $1,060,000 in your investment. The next year, it's not just $100,000 in growth, but $106,000. That way it can keep compounding every year for not just your life, but literally forever.
Of course, there could still be things like taxes on this, but it really depends on what investment strategy you are using. While something like stocks could give 10% return on investment, there are a ton of different investments out there that could potentially give dramatically more return on investment. In general, most people believe that the higher the risk, the higher the rate of return, or vice versa. While there is some truth to it, it's not completely true.
Depending on the investment, you could increase the return on investment with only slightly more risk. There are also investments that require active work, such as running a business or real estate, that can give you much higher return on investment.
For example, my favorite investment is real estate. And after factoring all income streams from what I can expect from it, I can expect roughly 12 to 40% return on investment. but I will cover more of that in another video with more details.
Back to Einstein saying, "He who understands it earns it. He who doesn't pays for it." I'm sure by now you can see that if you understand it, you can see how this powerful tool can work in your favor to grow your investments.
On the other hand, there are things that work against you in the same compounding way, such as credit cards. Credit cards have a 25% interest, which would be compounding against you every month. The balance on the card will get larger and larger every year if it is not paid off. Student loans work similarly, although they have much less interest. So depending on the interest rates of your loans, this could be something that slows your wealth building a tremendous amount.
These examples should be understood as educational information and not an investment advice. And we are not financial advisors. I'm not saying you should go and invest all your money into stocks and you would get these returns.
Investments do not perform on a consistent basis, and past performances are not a guarantee of future results. That being said, I hope that this video helped you understand how compound interest works and how investments in general can grow into generational wealth.
If you have any questions, email us at thefinancialtwins@gmail.com or comment below.